Welcome back, dear learners. Before the ad break, we were able to do some interesting adjustments, but I still have more that I want to do with you. The application question that I have for you reads, Jim, the owner of Jimmy Restaurant, has not been able to calculate the equity for this financial year. He does not know how to calculate the portion of the loan that will be repaid in the next financial year as well. May you kindly assist with the calculation of the owner's equity as well as the non-current liabilities after removing the current portion of the loan. That should be easy. Let's see what we can do. Make sure you have your calculator close to you. You need paper to write on as well as a pen or a pencil. We have an extract of a pre-adjustment trial balance of deals traders on the 31st of December. Okay? And then we have capital drawings and we have a loan from Land Bank. And then here's the additional information that we are given. Let's start with the first ones. We are going to record in note number 7, that is capital. So I'll come here and then I'll say balance at the beginning. I need balance at the beginning. I need balance at the beginning. All right? We are told that there is net profit for the year 125,000. However, this has not been recorded. Number 2, the owner increases capital by 80,500 during the year, and this has been properly recorded. So, when I come to my capital year, the 1,036,470, 1,036,470. There is an increase in capital of 80,500, which has been recorded already. So I want to know how much was it before the increase was recorded. So I'll come and say minus 80,500. I subtract it out. I would then remain with 955,970. This becomes the capital balance before the additional capital is added. And then I would then come and add my net profit. I'll add my net profit for the year. Net profit for the year. And my net profit for the year is 125,000. Remember, I'm adding this one. Then I'll come and add my additional capital that the owner has contributed. So I'll come and say plus additional capital contributed. And my capital contributed is 80,500. So I'll come here and say plus 80.5. All right. Remember, we are told that this was properly recorded. That was in the 1,036,470. So we took it out so we can get the balance at the beginning. We add our net profit, then we bring back that capital contribution now. And then we will subtract our drawings. All right? Drawings are 33,870. However, we are told goods with a selling price of 18,000 were taken by the owner for personal use. All goods are sold at a markup of 100%. That means I'm going to come here and I'm going to take my 33,870. Then I need to add these drawings. So I need to get the cost, which is 100 over 200. Multiply that by 18,000. That will give me 9,000. This is the cost of the goods that were taken for personal use. So I'll come and say plus 9,000. That becomes my drawings. And then I'll end up now with 42,870. I'm subtracting that amount. Therefore, my balance at the end becomes 1 million rather. My balance at the end becomes 1,118,600. 1,118,600. That becomes the balance at the end. There it is. Then I will bring that to my statement of financial position honest equity. Remember, I will then come here and I will say capital. I will say capital, note 7, 1,118,600. So my honest equity therefore becomes 1,118,600. Once I am done with that, there you can see it. The next adjustment reads, interest on the loan from Land Bank has not been entered yet. Interest is capitalized. The loan statement received from Land Bank reflected the following. And then here I have the loan statement. The repayments of the capital portion of the loan will remain constant in the next financial year. When you do your loan account, you have to remember that loan is a liability which will increase on the credit side and decrease on the debit side. So I'll bring my balance here, and I have my balance brought down, which is 270,000. And I have interest capitalized. Once I'm told that interest is capitalized, I'll bring it to the credit side, 45,000. My repayments for the year, that is bank, 85,000 will come to the debit side. So these are my repayments. What I need to get now is my balance carried down. So for me to do that, I'll come to my credit side, which is the higher amount, 270 plus 45. That gives me 315,000. I come to the debit side, 315,000. Then I say 315 minus 85. That gives me 230,000. 230,000. Therefore, my balance brought down here at the bottom, my balance brought down becomes 230,000. It is very important to remember that in my repayments, I have two amounts. I have interest first, 45,000. And whatever remains, therefore, becomes the capital portion that we have repaid. So I'll say 85 minus 45. That leaves me with 40,000 here, which you can get if you say 270 minus 40,000. It will give you 230,000. When we have this loan account, which is what you see there, you can therefore now complete your statement of financial position. And where we are beginning, we start with our non-current liabilities, loan Land Bank. I'll take the loan at the end, which is 230,000. We have been told that we'll make the same capital repayments on the loan as we did this year in the next financial year. In the next financial year, we are going to make the same repayments on the loan as we made this year. How much do we make on the loan this year? 270 minus 230. That gives you 40,000. You remember? We had another way of getting it. 45,000 here. Then we say 85 minus 45. You end up with 40,000. The second way of getting that 40. So it means we are going to pay 40,000 again next year. So I'll come and say minus 40 here. 230 minus 40. I end up with 190,000. That becomes my non-current liabilities, 190,000. And then that 40,000 becomes short-term loan down here, 40,000. That is the current portion of your loan. Once you have that, my dear learners, then you have done adjustments that affect your loan and you've recorded them in your statement of financial position. Let's go for a net break, and I'm going to see you shortly.